Good morning and welcome to this Monday, March 30th edition of Trading Places Live at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist here at EarningsBeats.com, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. No doubt we are probably going to have another volatile week. We're certainly getting somewhat used to that. I don't know if used to it is the right term or phrase, but it's what we have. So we have to deal with it and try to deal with it as best we can. It's been a very rough month of March, no doubt about it. I mean, there's been some crazy volatility, not just in the stock market. Of course, you know, that's what you're hearing about, the stock market every day, but the bond market, the dollar, gold, many commodities, you know, prices of oil. It has just been a crazy month, really, all around. You look at the major indices, stock indices from around the globe, and just about every one has seen significant deterioration during March, big bounce backs last week, and we're all trying to figure out, you know, what to make of it. What I hope to do here at Earnings Beats is continue to provide you maybe a little bit of a calming influence as to what's taken place and some of the things that we can do to try to protect ourselves during all of this. So let's go ahead and get into it. Today's show is going to be a little bit different than some of the others that I've done in the past, Trading Places Live, either here at Stock Charts. I've tended to follow a pretty strict format, you know, where we get into the daily market recap, talking technically, earnings spotlight, upgrades, downgrades, and so forth. Right now, to be quite honest, earnings, you know, the market really doesn't care. If you come out with a great report from last quarter, that has nothing to do with what you might look like next quarter. The market clearly is looking ahead, and most companies are not providing guidance as we look ahead because nobody knows what's coming. So, but there's a lot of smart money that's betting on certain areas of the market. And so we're going to spend a lot of time today. I did a lot of research over the weekend, a lot of studies, a lot of analysis. Had my spreadsheets out, my Excel spreadsheet. You know, I always joke, I never met a spreadsheet I didn't like, and it's really true. I love to analyze. And so wrote a blog this morning, just a little bit ago, over at Trading Places at Stock Charts. And I try to share a lot of the knowledge that I gain with our community here at Earnings Beats, also with the Stock Charts community. It's been a great platform for me, and I'm just paying it forward. I've learned a lot over the years from John Murphy and many of the others over at Stock Charts, and just always inspired by the work that John did, trying to find ways to analyze the market that maybe other people don't look at the market, to try to give us at Earnings Beats, all of our community, an edge. And so that's what this show and some of the future shows that I do are going to be all about, because let's face it, I don't know about you, but I don't remember the last global pandemic that we had to deal with. You know, this is something that's unnerving us in two different ways. You know, the financial crisis back in 2008, we were obviously worried about the our financial well-being, you know, worried about, you know, is our bank going to make it? You know, do I need to go, you know, should there be a run on the bank? Should we be putting our cash under the mattresses? I mean, I remember thinking some pretty bad things back in 2008 about our economy and how we were going to, you know, figure out how we could get out of that. Thinking some days, you know, we'll never figure this out. Well, we figured it out and we moved on. And now you look back and think, yeah, it was bad, but we made it. I think the same thing's going to happen here. But this one's got a little different characteristic to it, because not only are we experiencing obviously a financial crisis, but we also have a health crisis. And, you know, when you think about, I was just thinking about it earlier this morning, you know, when you wish somebody Happy New Year, you're always wishing them a healthy and prosperous New Year. And when you think about it, those are the two things that really are at risk right now for a lot of people and making a lot of people rightfully nervous. So we're going to, you know, we have to, you know, at least acknowledge what's going on. I think, you know, just pulling the covers over our head and saying, well, it's not happening, I think that's the wrong thing to do. But we can be smart about it, both from a health perspective, listen to the government, listen to the healthcare professionals. And so from a health perspective, we can do the things that we need to do to help protect ourselves and our family and our community. But financially, there are some things that we can do too. You know, I've said before, when the market gets really volatile, I don't like to be part of it. And that certainly helps. If you're not a part of this and you're not, you know, riding it down, of course, a lot of times that means you're not riding the bounces back up because you're not, you know, trying to time the exact bottom and the exact top. I mean, if you're trying to do that and you can do it, that's great. I mean, I commend you. Seeing it and then having that intestinal fortitude sometimes to pull the trigger can be two different things. I know last week at one point, I made a comment, and it may have been on Monday or Tuesday, right at the bottom. I indicated that we were moving down to new lows, but the VIX was not putting in new highs, that the VIX was actually coming down a little bit. And that was a short-term bullish development for the market. But did I go out and put 100% of my money in on the long side? No. It's hard. It's hard to pull the trigger when you're at this kind of an extreme with fear and panic. And because if you time it wrong by a day or two, it really can impact you psychologically. So for me, in this market environment and in any market environment with a volatility index like this, I tend to play it much safer. I don't mind being in cash, trading small positions. If I can make a little bit of money, I don't care if the market rebounds 10%. If I can just make a little bit of money and try to get myself through this period, that's my strategy. That's my style. Everyone else is different. Some want to just sit in cash, don't want to do anything. I understand that. Others, long-term investors, want to just ride it out. I completely understand that. And then you have others who are very aggressive traders who are trying to catch these swings in both directions. If that's your game, you know, I'll share everything I know about the market and everything I've seen to try and help in that regard, but that's not something personally that I'm going to try to do. All right, so let's take a look at first what happened on Friday. And well, let's move over to this chart first. So here on Friday, you can see the Dow Jones Industrial Average was down 4%. I mean, we were looking pretty good heading into the close. We were still down, but the Dow Jones was down a lot early in the day on Friday, came roaring back, and with 30 to 45 minutes left in the day, the Dow had erased almost all of its losses. I don't know if it was going to go green, but certainly you were thinking, hey, maybe this thing's going to turn green. S&P the same thing, NASDAQ maybe not quite as close, but still you can see all of these candles, we were much higher, literally 30 to 45 minutes before the close. And I think a lot of traders just said, you know what, I don't want to hold into the weekend. And I can't blame them. I mean, if you go back and look at some of the Mondays, some of the Monday mornings, we've seen some not so great action on Monday mornings because you've got 3 days, well, you know, the end of Friday and then you got all day Saturday and Sunday to build up potentially more bad news for Monday morning. So I understand the whole, I don't like holding right now overnight, period. But especially over a weekend, I could understand why a lot of folks were selling at the end of the day on Friday. But still, we look at what's going on. We are rallying from a Fibonacci standpoint. And those of you who follow the Fibonacci retracement areas, basically when you have a drop, and a lot of people use Fibonacci all the time. I tend to only use it when the fear goes crazy because I find that most support levels and so forth, price support, trend lines, moving averages, things like that, take a backseat to all of the fear and panic. It's like the market is irrational. Technical analysis is a rational. You're predicting what the market's going to do based on history and so forth. When the market gets irrational, you can't predict irrational behavior. It's very difficult to predict irrational behavior. So for me, technical analysis, as much as I love it, as much as I follow it and study it and teach it, I tend to ignore it during periods like we're in right now. Instead, I do like Fibonacci because when I go back into very panicked markets and I look at the Fibonacci, and I've been posting a lot of this, our members have seen it in our daily market report. Those of you who read my blog articles over at Stock Charts have seen it. I've been posting a lot of charts showing these Fibonacci retracement levels. And if you look back to 2008, you look back to 1987, two of the most volatile and fearful market periods of my lifetime, you see those Fibonacci retracement levels coming into play. And so those are going to be levels that are going to help guide me. Now, maybe this turns out to be a V bottom. Maybe the coronavirus just kind of, as we get into spring, kind of goes away and all of us and doesn't come back. That would be obviously best case scenario for the stock market. And I could see a massive rally if that happens. But am I going to get in 100% right now on the long side, hoping that that happens? No, that's not what I'm going to do. I'm going to prepare myself for what could be a more difficult environment going forward. So, I'm hoping and praying that that's our outcome, but I'm not going to invest my money hoping that that's our outcome. So the Fibonacci retracement, the first level is 38.2% of the decline. And so if you just, look back, most of the time in a steep decline like this, you'll see this back in 2008 and 1987, the 20-day moving average, because of the acceleration to the downside, and this period, by the way, the acceleration was actually a little bit stronger than during either 2008 or 1987. And when I talk about acceleration, momentum to the downside, I talk about the PPO. So when you look at the PPO, it's taking a percentage difference between two moving averages. I always use the default 12-day EMA, 26-day EMA. So the difference between those right now on the S&P, well, at the low, here's where you can see that. See this -8, it went below -8%. Back in 2008, 1987, I think 1987 might have gotten right about the -8%. I think 2008 might have been 7 or 7 and change. So the acceleration to the downside was just a little bit more pronounced here in 2020. But for the first time during this downtrend, we actually have a much more pronounced rally. And that's a good thing, because now we can begin to assess the key support level initially, and also on this bounce where we might go based on the Fibonacci retracement. So all of that I think is really important. And I know I'm spending a lot of time just kind of talking about this stuff, but I really believe it's important from a bigger perspective, looking at the big picture. And that's how I always do my trading, top-down approach. First, I want to know what's going on in the market. And then I want to know what's going on in the various indices and the various sectors, and then stocks within the sectors, using the scooters, using relative strength charts, volume analysis, price analysis, all these things come into play. But you got to start at the top, and the top is the big picture. So right now, I think the Dow, the S&P, major indices still have potentially a bit more room to the upside before I would say that, hey, we got to really be careful. I think we got to be careful now. But I think as we move up further and further into these Fibonacci retracement zones based on history and based on the way the market normally reacts during these kinds of periods, I think you want to be a little bit more cautious. Or if you like to short, you could start to become a little bit more aggressive. I've talked about, I don't know exactly where it turns. I think we do go back down unless the news really starts to improve. And I'm talking about the health news. If that happens, then I think we could continue to rally. If it doesn't, that's when I think we've got to be careful on these Fibonacci levels. But you can see across the board, none of the indices were able to clear the 20-day moving average. And we did roll back over on Friday. We'll see what today holds. As far as individual sectors go, you can see that the utilities down here failed at the 20-day. Real estate failed at the 20-day. Staples failed at the 20-day. Also notice that these three groups right here were the three best groups on Friday, and they're all defensive. So while the market was trying to react and come back throughout most of the day on Friday, money was rotating more toward defense. So even the rallies right now are still painting a picture of we need to be careful. Energy was the worst performer again on Friday. I mean, this group has just been beaten down so badly. I saw earlier today that the price per barrel of crude oil was back down to $20 or close to $20. These companies are going to really struggle with that kind of crude oil price. It's a demand issue, but it's also a supply issue. We have both, and that's what's sending crude oil prices just plummeting. We've seen it drop 2/3, more than 2/3 from its recent high. Right up in here, it was above $60. Now it's back down. Well, this is the XLE chart, but if you're looking at the crude oil chart, we were above $60 a barrel. Now we're down to 20. Technology also hard hit. There are pockets of strength, and that's what I want to focus on a little bit during this session. But first, let's take a look at the 10-year Treasury yield and get an update here where we sit currently. I do not like what's going on here. This is another thing that bothers me. Money is rotating into Treasuries this morning. We're now down 10 basis points on the yield. And I've said recently, this 0.65 to 0.75 area on pullbacks, that's where we've been holding on the yield. And so if we start to break that and start moving back down toward the lows, The problem is that when the yield's dropping, money is rotating into treasuries. Every dollar that goes into treasuries is a dollar that cannot go into equities. You have a choice to make. Professionals have a choice to make. You know, when you talk or hear from a Goldman Sachs or, you know, Fidelity or whoever, you know, they're talking about changing their allocation from 60% equities to 65% and lowering treasuries or, you know, their bond allocation. That impacts the stock market because that's a lot of money that's shifting. And so when I just look at it from a very simplistic standpoint and I see the yield dropping, that tells me money's rotating into treasuries. That's not good if you're holding equities because all of this money that's going into treasuries is going there for a reason. It's nervous money. There's a reason why consumer staples and utilities and real estate were leading last week. It's nervous money. So the market's very nervous. Those who are saying the bottom's in and, you know, we're likely to just keep rallying, I don't think the signals are telling us that. I think we have to be careful. Could it keep going? Sure, like I said. And we could have great news. You know, over the weekend, I think the percentage change in some of the countries around the globe came down a little bit. So the number of cases on a percentage basis actually slowed. We could use a lot more good news like that to continue. But there's still obviously a lot to you know, protect ourselves against, both financially and from a health perspective. All right, let's talk a little bit about, and by the way, we're going to have jobs out later this week. So if you think initial jobless claims were rough on Thursday and they're going to be rough again this Thursday, then we got the jobs report on Friday. And I think it's pretty clear at this point to most economists that we're in a recession. We're starting, you know, we're going to have a couple of really rough quarters at a minimum. And so as a result, and almost every recession you see corresponds with huge drops in jobs. And we're going to get that. I mean, just face it, we're going to get that. It's going to be rough, and it's going to be rough for a while. Some of the economic reports that come out are going to be stunningly bearish. But the market looks ahead. So, you know, a lot of times the market goes down in anticipation of all of this bad economic news. And then the news comes out and the market starts going up and people shake their head. Like, well, how can the market go up? You know, they start shorting after the market's already taken a big hit, thinking that, okay, I'm getting in before we have the really big drop. And a lot of times the big drop's already been had. So we need to watch that recent price support on the S&P and on the Dow, see if that holds, see if the volatility index comes down, see if the shift in money starts rotating a little bit more toward aggressive. These are some of the subtle signs that we'll be looking at here over the next several days to several weeks. All right, so let's look at the dollar. I mean, here's the US dollar index. I've never seen a month like this. This is crazy. I know it was very volatile back in 2008 with the financial crisis, but I mean, starting right when the market topped, the S&P, this is on February 9th. Actually, I think this is February 20th, but the S&P topped on February 19th. Look at the dollar going down. So it looked like, okay, the dollar was in free fall. We went from 99.75, almost 100 on the index, down to 94 and change in about 2.5 weeks. That was a massive move. And you look at the dollar usually doesn't move in this kind of increments. I thought that was a big move until I saw the next 2 weeks when we went from 94 to 104 and thought, wow, okay, well, everybody's flocking to the US dollar. That's a safety measure. But then last week, while the markets are rebounding, you can see the dollar taking a major tumble. And so the instability of the dollar right now is another thing that's, I think, worth keeping an eye on. We're almost right where we started the month, but how we got there is crazy. And if you look at a monthly, I got a 15-year monthly chart. Look at the long tails. These tails on candlesticks are simply marking the high and the low. That candle body is the difference between the beginning of the period and the end of the period. So it's a monthly chart. So it's beginning of, and that's what I was just saying. We're almost right where we were to start the month. The problem is we have been all over the place. The dollar has been going absolutely crazy. And of course, that is sending gold crazy. So if you look at the gold index or the gold contract, you can see we went all the way down, tested the 20-month moving average at roughly 1460. Ended the week at 1654 and had a high of 1704. The dollar and gold move inversely historically. They tend to move inversely. It's not a 100% inverse, but they move pretty much inversely one another. And so when the dollar's going crazy back and forth, gold's doing the exact same thing. But gold and gold mining, or gold mining and mining industry groups were the two best groups, or have been the two best groups since February 19th. Now, I'm not shocked, because anytime the market panics, one of the outlets for cash is to go into gold. So the fact that gold is leading, I don't think that's a paradigm change. I think that's just standard. That's what happens when the market gets fearful. So I want to talk a little bit now about some of the changes that I'm seeing in the market. And I don't know if you saw my article in Trading Places. I literally published it just before the show today. But what I do when I see things in the market that I think have a very relevant impact on how the market may trade going forward, I start looking at key dates. For instance, February 19th, that's when the market topped. The low last week, I think that initial low after we dropped 35% is an important level. Where did everything trade on February 19th? Where did everything trade last week when we hit the low? Where did everything trade when we bounced last Thursday and hit our high? And where, I don't know, in a week or two, we'll probably be at another really important inflection point. Where is everything trading at that point? And what I do is I look at the shifts to see what was leading the market, both on the downside and on a relative basis to the upside, during that big move from February 19th to March 23rd. That was the low close, March 23rd. Or actually, that was the intraday low, not the low close. I went to intraday low. Now, not every index, not every industry group printed the high on the same day, February 19th. Not every industry group printed the low on the same day, March 23rd. Many of them were quite a bit different. But what I'm looking at is the S&P 500 as of those 2 days and the industry groups as of those 2 days, because I can look, I know the S&P went down X percent, and I can say, okay, well, these industry groups outperformed by a wide margin. These other industry groups did not. And I can begin to formulate some strategies going forward based on how Wall Street is viewing all of these companies. Now, I think Wall Street is pretty darn smart. They've got a lot of economists. They've got access to healthcare experts. They've got things that you and I don't have. So watching what they're doing with their money, I think, is incredibly important to what we should be thinking about doing with our money. If they're going into an area of the market, then we should be thinking about going into that area of the market or trading that area of the market. So when I looked at this, and I went through all 104 industry groups, and I've got all this data on a spreadsheet, worked on this all day Saturday, and wanted to share this with everyone. It's kind of hard to write an email to share it, but I can talk a little bit about some of these charts. Looking at some of the groups that have not performed well over the last month, and I'm sure many of you know a lot of these groups. You might not realize that the coal industry is the worst. So if I go in here and just take a look at the coal, DJUSCL, on a percentage basis since February 19th through March 23rd, this was the worst performing group. And even when we bounced last week, coal did not bounce. So this is a group. Now, they did bounce back in the middle part of March. I was saying, some of the lows don't necessarily coordinate or coincide with the S&P. This was a perfect example. Big move up, rolled back over. So coal is an area I wasn't looking at really to begin with, but it's definitely not an area where the market's performing well, or where that group is performing well. Aluminum, same thing. Now, coal, of course, part of energy, aluminum, part of materials. Energy and materials continues to be very, very difficult area of the market. And unless the dollar comes crashing back down, I think this is going to continue to be a rough area of the market. I don't own anything in materials or energy, have not been trading the group, and I'm just simply avoiding. I just don't see any need at this point. I'll be watching the dollar. I think if the dollar, being as volatile as it is, if it really does start a much bigger move to the downside, then I think perhaps some of the material stocks may come into play. Other areas, recreational services. I think that this one goes pretty much without too much discussion. Think about cruise lines. I mean, they're part of this group. Huge move down. Yes, it was a big rally, but my gosh, we dropped from February 19th to from 130 down to 30 in this group. And you can see this group bottomed before the 23rd. So this group actually bottomed a little bit before. I think part of that was because of options expiring. That would have been this week. Options expired. I think that saved market makers a ton of money. I think they finally got to the point where they said, hey, we got to support this. One thing I'd be a little careful about is notice a lot of tails to the upside during this move. So even though prices have been moving up, look at the accumulation distribution continuing to move lower. This is not a group being accumulated. It's a group I would completely stay away from. I think we're going to see bankruptcies, and best case, we're going to see bailouts. And I'm not even sure we're going to see bailouts in cruise lines. I'm not going to get into all that, but this is an area I think you got to be very careful about. If I was in and I got that bounce last week, I'd been out. I wouldn't take any chances. I know sometimes if you're holding something and it's dropped 80%, you get a little bit of it back. You think, well, I want to get a little bit more back. And next thing you know, you're down to a new low. We had that pain, remember, with a lot of the dot-com stocks back in the early 2000s. Big move down, they get a bounce. You think, okay, here we come. We're coming back. And next thing you know, it was a new low. Be really careful of these companies that Wall Street's ignoring. Other areas, gambling stocks. Gambling stocks, their initial drop was 57%. That ranked 90th out of 104 groups. So gambling stocks, big drop, came back up, failed at the 20, moving right back down on Friday. Be very careful here. Airlines, some of these are obviously ones that you've heard about. Apparel retailers lost 62%. 99th out of 104 retailers during that initial drop. They're ranked. Now, I also ranked them on the bounce, and some of the ones that got hit the hardest got the biggest percentage bounces, which makes sense. Some of it, I think, was market maker induced. I really do. I think a lot of it had to do with the options expiring and trying to be made whole, trying to get, make more money. Some of these financial firms, it's almost a bailout for them every month as you go into options expiration because they do make a lot of money, especially with respect to the unsuspecting. Let's see, what else to the downside? Hotels, some of the REITs, hotel and lodging REITs, dropped 60% during that initial drop. Had came back, 49.8%, which was nice. 3-day recovery. That ranked 7th out of 104. But again, big drop down, big rally. But now I think you got to be real careful going forward. So let's talk a little bit about what is working in this market. And I'm probably going to go a little bit past 9:30. I just think there's a lot to talk about. Mobile telecommunications. I wrote about this in my blog article. So let's just pull this up. When you look at these charts and you say, well, it's going down. When you look at the chart, you don't really see relative strength unless you have a relative strength chart up. You just see everything's going down. I mean, my initial look at this chart, I'd say, well, down. It's lost its support. It's not looking that good. But when I look at accumulation distribution, it just set a new 52-week high. A lot of rebounds off of intraday lows. So there's buying throughout the day, which you can see it's reflected really in accumulation distribution. This is one of my favorite indicators I'm using right now at stock charts. Accumulation distribution. I think it gives us a little bit more than just did something go up or down. If it's going down at the open on a gap, but it's being bought during the day, to me, that's not nearly as bearish as something that's gapping down and continuing to sell off during the day. Or worse yet, gapping up and then selling off all day. And you can kind of look, without even looking at the accumulation distribution, I can look at the candles. And when I'm seeing a lot of hollow candles, that's telling us the closes are above the opens. And so without even looking down, I would say that the accumulation distribution is going to be pretty strong on a chart that looks like this. And it is. It's still up near a 52-week high. So if I'm left with an option of what I want to trade, do I want to trade cruise lines or do I want to trade mobile telecommunications? For me, I want to trade mobile telecommunications. Wall Street's telling me on a relative basis where we are now versus where we were on February 19th, mobile telecommunications is down 11%. The S&P 500 is down 25%. Money is rotating into this area. Whether you like it or not, whether you agree with it or not, it's happening. So you can recognize it, be aware of it, have that knowledge, or you can ignore it. Your choice. I think it's worthwhile knowing that that's what's taking place. Some other areas of the market that are performing really well. Non-durable household products. And by the way, when you get this information, let's go over here for a second. And you say, okay, well, that's an index. I can't trade the index. So what do I do with this information? Well, we can go down to, oh, wait a minute here. All right. We can go down to, well, let me look at this one other way first, because I want to show you, those of you that have an annual membership with EarningsBeats, we send you the relative strength industry group chart list. And another way of looking at relative strength is simply going down, looking at all these that we've sent you. But I want to go through and just show you. Yeah, under the, this is the DJ USHN. So on a relative basis, if you were going through all these charts, this is what you'd see, okay? So if we go back over here, so if you look through there and you say, okay, that's a group that's doing really well. If you go into consumer staples, you can see on Friday, it was the best performing, oh, this is actually today. So because the market is now open, we're a minute in. So today, non-durable household products is leading the market. Drug retailers, this is another group that's been doing very well on a relative basis. It's outperformed the S&P by 8 full percentage points since February 19th. So paying attention to what's leading, you can see that these two groups are continuing to lead. So you might say, okay, well, if non-durable household products leads the market, how do I benefit from that? Well, you can go in here first and just click on it to get some of the names of the stocks. Maybe put them in order of the scooter. Clorox, this is a name that I gave to our members last week. I trade Clorox. I own it right now. I think Clorox is a good name. When you look at the chart on Clorox, again, you can see, well, about a week or maybe 2 weeks ago, we were at a high on the accumulation distribution. That definitely came back down, but we came back down. We held the prior low, which was good, held the 50-day moving average, which was good, and now we're moving back up above the 20-day moving average. We're in an uptrend, and we know that the group is performing very well relative to the S&P 500. So these are all things that I think that, you know, we need to be aware of as traders. Now, long-term investors, you know, if you're in it for the long haul, this doesn't matter. Although, you know, I'm not, usually when things get hectic and fearful for a period of time, I always talk about the ETFs being better investment vehicles. I'm rethinking that, to be honest, because the problem with the ETFs, like the Spider, is that you've got a lot of stocks in there that are financials that are struggling. A lot of, maybe not as many now, but energy stocks, materials, some of the areas that I don't want any representation. And yet we're still, you know, we're basically trading by getting an ETF that covers the whole spectrum. We're taking a lot of really bad stocks and owning them in order to own some good ones. Why not just own the good ones? I know that sounds a little riskier, and it is on the one hand, but diversification, and I don't remember the exact quote, but Warren Buffett, which I think everybody will agree is a pretty darn good investor, came out and basically said something about diversification is really more, and I'm paraphrasing, but basically diversification is more ignorance on the part of traders than anything else. They don't, it's not that it's a bad thing. It's just that they don't understand where they could be investing and doing better with their money. So the whole idea is to have that knowledge. Number one, what areas are leading the market? Let's invest in those areas. Why? And you might say, well, you know, but airlines create great value right now. Well, not if they go bankrupt. And even if the stock, or even if the government bails them out, what's that going to look like? Are they going to own, is the government going to own some of this? And how many shares are going to have to be given up for the government to take ownership? It could be a diluted group that may take years to come back. I don't want to be part of that. I want to actually be part of groups that will benefit going forward, not just from what's happening right now with the coronavirus, but with paradigm shifts. You know, people that are now coming home and working from home, you might think, well, yeah, this is only going to be for a couple months. Once companies realize how efficient it is to work from home and to collaborate online, you think they're going to want to go out and rent another building or go out and, you know, create more expenses and have their employees driving, having to come up with parking, and this is much easier. And so I think that's one major paradigm shift, is that any companies that provide online communication and collaboration, those companies are, I think, going to do very well going forward. And so one of the companies I mentioned that I do own right now, and about to check it out for the first time while the market's open, Zoom. It gapped up today, has come back down, but it's still up $3 today. Zoom, I think, is a great candidate. And again, full disclosure, I own it. Do your own due diligence. But this is a company I've mentioned to members for a while now. Actually, I was mentioning it back in the middle part of March when it had pulled back. I know it was in one of our, it was either in the DMR or it was in the shows that I do. I talk about so many things in so many places. I can't keep track of it anymore. But Zoom was down at about 110 when I really started talking about Zoom. Another one that I talked about was Slack. And I talked about Slack back when it was in the teens, and you can see the huge move that's made. This one wasn't really doing that well on a price basis, breaking down. Look at the accumulation distribution. You see the difference? Prices going lower, accumulation distribution going higher. Mark Chaikin came up with this indicator, and I think it's a brilliant indicator. You know, there might be ways to tweak it, but overall, I think this gives you a really good sense of what's taking place, and it can give you ideas on stocks that maybe initially might not meet that eye test. You might look at it and say, wow, it's breaking down, not one I want to consider. Accumulation distribution says, yeah, you want to consider it. All right, another area of the market that I think we need to be taking a look at, broadline retailers. Some of these companies are figuring out new ways to do things, given the coronavirus and the people staying at home. I mean, you know, you now have curbside pickup. You have so many companies delivering right to your doorstep. You got Instacart, you know, companies like that that are willing to go out and do your shopping for you so that you can more easily socially distance yourself. And, you know, social distancing, while I'll be honest, I don't care if I ever hear this term again after 2020. It's probably going to change a little bit about our culture and the way we do business and the way we, you know, we're going to probably have less face-to-face meetings and so forth. So finding companies that can grow and that are innovative. I mean, that's the one thing that's great about not just the US, but really our global economic environment is it, and especially here in the US, we do promote innovation. And we've always been able to innovate. And when we come out of this, it's going to result in a lot more innovation. There are going to be new industry groups, new things that we're not even thinking about right now. People are just that smart to come up with ideas and then see them through. So I'm very optimistic about the future. Short term, yeah, it's rough. It's rough on all of us, but we're going to get through it all together. It's going to take, you know, a lot of effort, a lot of different people, socially, from a healthcare perspective. And please, I encourage everybody to listen to the healthcare experts out there. You know, they're not just telling us this just to speak or to have the stage. You know, you can probably see it already in your communities. If you haven't, all you have to do is take a look at New York, Seattle, Washington, areas in California, now down in New Orleans, what's happened over in Italy, China, you know, the UK, everyone's shutting down, looking at these large cities that look like ghost towns right now. This is the real deal. It is something that we need to all work together to, and we'll get past it. But the more we can all come together and work together, the quicker we'll get through it. And then the brighter it'll be on the other side. But in the meantime, these shows and what we do for our members and our community at EarningsBeats is going to continue. Like I said, I worked quite a bit on Saturday trying to go through and identify some of these other areas. And I'll tell you, you know, a couple other areas before we wrap up that I think are interesting. Toys. You know, when you're at home all day and you got your kids home and there's no school, some of the toys looking pretty good. Look at the accumulation distribution on the toys index. Mid-March, when it was setting its new lows in price, it was setting new highs in accumulation distribution. A lot of hollow candles in here. And it makes sense when you think about it. You know, if you're going to be home with your kids, order some toys online, get them some stuff at home to play with. And if more people work from home, it's going to cut down on childcare. And if they're going to have their kids at home with them, this is a group that could benefit longer term. These are the ways I think that we're all going to have to be thinking. Another group, and this is a no-brainer to me, biotechs. Given what's taking place right now, obviously there are a lot of individual biotechs that are doing well, but I think the overall group, I think that now we are going to probably fund for the next so many years a lot of these biotech companies to help us in protecting us in the future. So I think that there are going to be some real big winners in the biotech space. When you look at the accumulation distribution, huge drop in price, but while the prices kept going lower, accumulation distribution did not. It's holding up well. On a relative basis, biotechs during that big drop on the S&P, biotechs lost 14%. The S&P dropped 25% from high to low. So, you know, there are definitely areas of a market where we need to be focused on as we go forward. And as this continues to change, I'm going to continue to monitor it, and I'll be passing it along. I would encourage, you know, those of you who are already members, first of all, everybody who is supporting us at EarningsBeats, thank you. We certainly appreciate it. Those of you who would like to be part of our community, our paid community, we do have a $7 30-day trial. You can check us out, see what you think over the next 30 days. I think this would be a great time to have a trial. Your $7 is fully refundable as well. So you'll be charged $7, but we'll give it back to you. So literally for 30 days, it's free to try out our service. We do the best we can to try and help our members get through a really tough period. So again, thank you to all of our members. Thank you to our community. We're going to get through it all together. I have no doubt about that, but it's going to be tough. And the other thing I would say is that we are actually benefiting from the online. You know, we are already set up to do this from an online communication and collaboration standpoint. That was one huge benefit for our business. I mean, everything I do at Stock Charts, everything I do here for our members in the Zoom room, sending out the emails, we can do from home. And I know a lot of you all are going to be at home for the next, you know, maybe 30, 60 days that ordinarily wouldn't be. So join us. I mean, we'd absolutely love to have you. So again, you can sign up, and I'll just point you in the direction. If you go into EarningsBeats.com, just go into the About Us area, and you can scroll down here, $7 special. And when you click on this, by the way, right in here, you'll see you will initially be charged $7, but we are going to fully refund that right now. So you've got a free trial for 30 days. See what you think. Those of you who are on a monthly plan right now, think about upping to an annual. You're going to save a lot of money, and we're going to walk you through this period as best we can over the next year. Like I said, we'll get through it. We'll get through it together, and I have no doubt about that, but we do have to be smart. All right, I'm going to go ahead and wrap up. No 3 and 3 today. Just consider some of those individual industry groups as the 3 and 3 is probably more like about a 7 and 7, or maybe a 7 and 15. But those are some of the things that we need to be thinking about as we go forward. One last thing before we exit, let's just see what the market is doing. Right now, Dow down 75, S&P up 7, NASDAQ up 50. So a little relative strength on NASDAQ. Maybe a quick look at Apple, see what Apple is doing. Apple up $2.80, still below its 20-day, trying to recover. Apple's held up pretty well, accumulation distribution. And I would suggest if you don't already have this as part of your regular charts, I think it's maybe one indicator you may want to add. And I wouldn't necessarily trade specifically off of this indicator, but it could be a confirming signal for you on if you're thinking about buying or selling a stock. It's something maybe to consider. All right, let's go ahead and wrap it up. Appreciate everybody tuning in. I'll be back tomorrow over at Stock Charts. We are continuing to do recorded sessions at Stock Charts. So I'll be recording them probably around 7:15, 7:30 in the morning. And then Stock Charts will replay the recording at 9 a.m. Eastern. So, and then I'll be back here at EarningsBeats on Wednesday. Everybody have a great day. Stay safe out there, and see you tomorrow. Take care.